Ever wondered what strategies successful millionaires use to grow their wealth? It's a question that piques curiosity, isn't it? It's not just about having money, it's about making it work for you. This is where a solid investment strategy comes into play. In this video, we'll be exploring 10 popular investment strategies that millionaires swear by. These strategies have powered their journey to the top, and could potentially do the same for you. So, stay tuned as we unveil these strategies that can potentially skyrocket your wealth. The first strategy on our list is diversification. Now, what does that mean? Picture a buffet. You wouldn't load your plate with just one item, right? You'd want to sample a bit of everything. That's diversification for you. By spreading your investments across different asset classes like stocks, bonds, real estate, or even commodities, you're essentially reducing your risk. It's like saying, don't put all your eggs in one basket. Take a cue from successful investors. They don't just stick to one type of investment, they diversify. Consider someone like Warren Buffett. He has investments in everything from candy companies to insurance firms. This strategy helps buffer against market fluctuations. If one sector takes a hit, others might be performing well, balancing out the losses. In essence, diversification is your safety net in the unpredictable world of investing. So when you're planning your investment strategy, remember this golden rule. Don't put all your eggs in one basket. Next up, long-term investing. Picture this. A sturdy oak tree that has stood the test of time, weathering storms and growing stronger year after year. This is the essence of long-term investing. Sturdy, resilient, and ever-growing. It's a strategy that hinges on the power of perseverance and patience. It's about planting the seeds of your wealth and letting them grow over time. By keeping your money invested for long periods, you're not just aiming for higher returns, you're also harnessing the power of compounding interest. This is essentially the snowball effect, where your earnings generate even more earnings. Think of it this way. You're not sprinting towards a finish line but embarking on a marathon where the journey counts more than the immediate gratification. It's not about timing the market, but time in the market that matters. In the game of investing, the tortoise often beats the hare. The third strategy is regular rebalancing. Now let's dive deep into what rebalancing actually means. Imagine you're a chef, and you're trying to maintain a perfect recipe. The key is to keep the right balance of ingredients. Likewise, in the world of investing, rebalancing is the process of realigning the weightings of your portfolio of assets. Over time, some of your investments may become too large or too small relative to the others. So why is it important? Well, it's all about managing risk. If one asset performs exceptionally well, it could become a larger part of your portfolio, and thus increase your risk. Regular rebalancing helps maintain your desired level of risk by trimming back the asset classes that perform well and adding to those that lag. Think of it as a form of discipline, a way of ensuring you're not putting all your eggs in one basket. And remember, regular rebalancing ensures your investment portfolio stays aligned with your financial goals. Fourth on the list is dollar cost averaging. Now this strategy is all about consistency and discipline. It's like going on a financial diet where you invest a fixed amount regularly, regardless of the market's ups and downs. Here's how it works. Instead of putting a large sum into an investment all at once, you break down your total investment into smaller, consistent amounts that you invest at regular intervals. This could be weekly, monthly, or quarterly. This method can be a fantastic way to mitigate the impact of market volatility. When prices are high, your fixed investment buys less of an asset, and when prices are low, it buys more. Over time, this can result in a lower average cost per share, hence the name dollar cost averaging. It's a simple, yet effective strategy, especially for those who are new to investing or those who prefer a less risky approach. With dollar cost averaging, consistency is key. The fifth strategy is investing in what you know. This concept is as simple as it sounds, yet its impact can be profound. By investing in sectors or companies you are familiar with, you're leveraging your existing knowledge and insights to make informed decisions. Think about it. You wouldn't buy a car without understanding its features, would you? The same principle applies to investing. Let's take Warren Buffett, one of the most successful investors of all time. Buffett's investment philosophy is deeply rooted in this strategy. He invests in businesses he understands, ones that are within his circle of competence. This approach has earned him a fortune and cemented his place among the world's wealthiest individuals. So before you invest, take the time to understand the business or industry. Research, learn, and grow your understanding. It's not just about the numbers, it's about the story behind them. Remember, in the world of investing, knowledge is power. Now we move on to the remaining 5 strategies. First, we have value investing. This is the art of buying stocks that are undervalued in the market. The goal here is to buy these stocks at a price that's below their intrinsic value. The investor then waits for the market to recognize the stock's true value to make a profit. It's like buying a dollar bill for 50 cents. Next up is growth investing. This strategy is about investing in companies that exhibit signs of above-average growth, even if the share price appears expensive in terms of metrics such as price to earnings or book-to-market ratios. The underlying belief is that these companies' rapid growth rates will ultimately lead to higher-than-average returns. The third strategy is passive investing, specifically through index funds. An index fund is a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a market index. It's a strategy that offers broad market exposure, low operating expenses, and low portfolio turnover. So if you're not keen on picking individual stocks, this strategy might just be for you. Then, we have active investing or stock picking. This strategy involves an investor or fund manager actively choosing specific stocks to invest in, based on a variety of factors. The goal is to beat the market average and achieve higher returns. However, this strategy requires a good deal of research, time, and knowledge. Lastly, we have real estate investing. This strategy involves purchasing properties to earn returns either through rental income or resale. It's a tangible asset that can provide cash flow, tax benefits, and potential appreciation. Real estate can be a great way to diversify your investment portfolio beyond stocks and bonds. These strategies offer different approaches to investing, each with its own set of advantages. Let's recap what we've learned today. Our journey began with the concept of diversification. We've seen how successful millionaires don't put all their eggs in one basket. Instead, they spread their investments across various asset classes like stocks, bonds, real estate, and more, to mitigate risks. Then we moved on to long-term investing, a strategy that emphasizes patience and persistence. It's not about making a quick buck, but about growing wealth steadily over time. It's about harnessing the power of compound interest, which Albert Einstein famously referred to as the 8th wonder of the world. In the third strategy, we delved into the importance of regular rebalancing. This means adjusting your portfolio periodically to maintain your desired level of risk and return. It's a bit like a financial health checkup, ensuring your investments are aligned with your goals. Next, we explored dollar-cost averaging, a technique that involves investing a fixed amount of money at regular intervals. This strategy can help smooth out the highs and lows of market volatility, and over time, can potentially lead to a lower average cost per share. The fifth strategy took us into the realm of investing in what you know. This means putting your money into industries or companies you understand and believe in. It's about leveraging your knowledge and insights to make informed investment decisions. Finally, we covered 5 more strategies, each unique yet interlinked. These included value investing, growth investing, income investing, index investing, and socially responsible investing. Each strategy has its pros and cons, and the best approach often involves a combination of these strategies based on one's financial goals, risk tolerance, and investment horizon. In essence, we've unraveled the investment strategies of successful millionaires, providing a roadmap to follow in their footsteps. From diversification to dollar-cost averaging, from long-term investing to investing in what you know, we've covered a wide spectrum of strategies that can help you build and grow your wealth. But remember, these strategies are not a one-size-fits-all solution. Personal finance is indeed personal, and what works for one might not work for another. It's crucial to understand your financial situation, your investment objectives, and your risk tolerance before choosing the right strategy for you. In conclusion, having a solid investment strategy is vital in your journey towards financial success. It's not just about making money, but about making your money work for you. It's about creating a future where financial freedom isn't just a dream, but a reality. Remember, the road to wealth is paved with smart investment strategies. Thank you for watching, and here's to your financial success.